Hi, good evening to all. We are starting pretty soon over here. So before we start, a bit of technical check first. So can you all hear my voice and see my screen? Yeah. So can anyone just give a shout out over the chat, your chat box over there, using the chat box on? I think it's only the little chat box, just at the bottom of the screen. So can anyone hear my voice and see my screen before we kickstart this webinar? Good, good. Thank you so much, Jack. You actually responded. Very good evening to you. So let's wait a couple of minutes more, maybe 2 more minutes before we kickstart, because we sort of don't want to delay, as we have lots of interesting charts and as well insights to share with you all. And hopefully you're able to get back some insightful stuff for this very interesting Q3 uh, time horizon on the global markets. Yeah. Okay. 1 more minute to start. Okay, good. Let's get started over here. So, very good evening, ladies and gentlemen. So, I'm Kelvin Wong. Welcome for today's webinar, hosted by CMC Market Singapore, presented by myself. I'm actually part of this APAC market analyst research team in Singapore, Australia, China, and as well as New Zealand. So, we'll be presenting our Q3 global markets outlooks. And most important thing over here is, as you all know, that officially the major stock market, which the US stock market, has entered into a bear market territory at the end of Q2, because they actually fall more than 20%. So right now, most importantly, after last 2 weeks of movement, are we now totally out of sight or of the bears? That means a bullish reversal or a continuation of the bears in the US stock market, which is primary very important as well for the rest of other asset class like the US dollar, the commodities, cryptocurrencies, and even the Singapore stock market. So before we start, let's take a look at the disclaimer slides first. All right. Okay. So basically, this myself, I've been in the market for close to 14 years, both as an analyst as well as a trader and consultant. With the buy side, that means I do give advisory before for hedge funds, clientele, looking at how the markets actually behave and doing a bit of forward looking setups based on technical analysis, fundamental, and fund flows. And for those who actually want to follow me on social media, so later I'll share with you my social media account, which is I mean, if you guys can follow me, good. Why? Because every morning I will write a Good Morning Asia daily commentary. What are the key important things to actually look out for, and how does this key important news event play out in the coming weeks or even the coming months? So I'll talk more about that towards the end of this webinar. All right. So I do understand that maybe some of you have some questions, but do keep your question towards the end. So this is a 1.5 hour webinar, but I will try to aim to complete within 1 hour and 20 minutes, leaving the last 10 minutes for Q&A question. All right. So without further ado, let's get started. All right. So a quick recap. So this is for those who have followed me in since last year, where I will actually, before we start a new Q3 outlook, we give a report card for our Q2. what works well, what doesn't work well in our idea. So previously, when I presented our Q2 global markets outlook, somewhere around in Q2, that means about 3 months back. So we're talking about stagflation risk coupled with heightened geopolitical tension and potential currency war by the rapid pace of this depreciation of the dollar yen and the China offshore yen, the CNH. So we are actually likely to kickstart the first leg of this long-term circular multi-year bearish trend for risk asset with equities. So this actually turned out as expected. So you all know that the SPX and the rest of other major stock indices, like including the Singapore stock market, with the exception of Hong Kong and China, we'll touch on more about that, it actually fall into bear market territory. Then we also talk about that 60-40 portfolio. What 60-40? That means traditionally, if you those guys who are in long-term investment, you tend to diversify 60% in equity, 40% in fixed income. Fixed income, it can be corporate bonds, it can be sovereign bonds, but we know that they could be badly hit, which is pretty sure as well, which is actually turned out as expected, where you start to see corporate bonds falling, prices of bonds falling hand in hand together with prices of equity. So they actually limited diversification, which turned out as expected. Then we're also looking for a potential major regime change where previous multi-year outperformance, tech and growth equities, we are expecting them to underperform in Q2, which turned out as expected. Why? Because of the last 10 years has been triggered by a rapid pace. It's heavy loop-sided positioning, and in Q1, Q2, there was actually a rapid rise in treasury yields. That means indirectly higher cost of funding. And we also do expect commodities expecting to outperform as well. But however, it's only for oil and the energy portion, but not across the board. That means gold still kind of lackluster. And agriculture tends to give back a bit of rally that was actually seen in Q1. All right. Then the next one over here is we expect further potential dollar strength, which turned out expected, except against the Canada dollar, which remains flat below 1.3020. And at that point in time, we turned neutral on cryptocurrency because of mixed elements. But however, Bitcoin and Ethereum fare worse than expected as it broke below this major range support level that we highlighted in our Q2 2020 outlook. So all in all, right, our report card seems pretty much what we call it fare pretty well. I mean, all our forward-looking views actually came out as expected. All right. So now, basically, what we are saying now is this: what happened in Q1 and Q2? Stagflation risk up, geopolitical risk up, hawkish Fed risk off. All right, but that is in Q1 and Q2. And going forward, Nick, what will happen in Q3? All right, so now when we are talking about looking for tactical investing, we call it a setup, we always got to be forward looking and pierce into the crystal ball and get an idea how will market actually perform next by looking at various leading indicator that that actually learned from my previous mentor and my previous work experience in the last 14 years. So this is where I wanted to share with you all my expertise in this area. So hopefully that all of us can get better insights into the global markets. So basically, right, this is the Q1 and Q2 report card across the across major asset classes. So the top over here will be the global equities. So the top four is the major US indices. So I believe that everyone should know what is the S&P 500, the Nasdaq 100, the Dow Jones Industrial Average. Russell 2000 is considered as the US small cap. That means the small cap company that is, we're talking about more highly, we call it growth oriented. Like for example, recently you're talking about that cinema, AMC is one of them. All right. That if you look at their performance is pretty lackluster in Q1 and Q2. All of them actually tumbled. And the worst is being fed in Q2. Okay, where the worst hit the tech and growth sector, Nasdaq 100 heavy weighted, which came out expected, fared the worst among the major US stock indices, down by negative 22.47%. So all in all, if you add this up together, simple addition, we know that the US stock indices has entered into a bear market officially by a definition of a minimum 20% decline from the top, from its peak. All right. And what's interesting over here is that the Hang Seng Index, the Hang Seng Tech Index, as well as the CSI 300, which is considered the benchmark for the China stock market, comprises of China equities listed in both the Shenzhen and Shanghai Stock Exchange. Okay, so I tend to look at the CSI 300 as a broader view of the China stock market. So if you look at Q1 was pretty dismantled, we call it pretty dismal, or we call it horrendous performance, especially the China big tech stock, which is represented by Hang Seng Tech Index. So cut the story short, you all know that why is it underperforming? Because of the stringent, we call it regulatory driven clamp down on the business model of the China big tech like Alibaba, Baidu, and even Tencent. But however, their fortune starts to turn on Q2, where actually they are actually the outperformer among the global stock indices, including the US and including Europe and in Singapore as well. Okay, so you look at the performance of Hang Seng Tech, positive 6.8%, China CSI 300 positive 6.21%. Okay, and the rest you can actually take a look over here. And what's on the highlight over here is these three over here are considered fixed income instrument, which is this is the iShares 20-year Treasury bond. These bond prices. That means we're talking about a very considered risk-free instrument. Indirectly, I would say more or less risk-free because there's very low chance that the U.S. government will go bankrupt. Okay, so this is considered as a 20-year Treasury bond issued in a way by the U.S. Link up to the US government. So what I could see over here is that in Q1, Q2, both of them are actually negative 10% and negative 30%. If you go to the investment grade corporate bond, similar as well, negative performance, negative 8, negative 9. If you go to the higher risk bond, we call it the considered as a high yield corporate bond, bonds that offer higher yield but higher credit risk, negative 5%, negative 10%. So this is why I explained the 60-40 portfolio actually got hit in Q1 and Q2. That means if you have this 60-40 portfolio, if you have faith in it, you trust in it, this is where you start to see your portfolio bleed as well because of the bond prices came down together with equity prices. Why? Because in the last 10 years, we are actually, both of these two instruments are determined or are significantly influenced by low cost of funding environment. That means we're talking about low interest rate environment, where if there's a sudden shock to this system by a little increase or the change of tonality by global central banks, like the Fed, which actually turned at the start of this year saying that, hey, inflation is no longer transitory and they are getting more and more hawkish as we progress from Q1 to Q2. So this created a negative feedback loop into these two asset classes, which their return in the last 10 years has been primarily determined by low interest rate. All right. So WTI crude definitely benefited from it, this environment of heightened inflation rate, plus 34%, but their return starts to reduce in Q2, 4.7%, especially towards the month of June. In the month of June, where actually they actually tumbled by close to I think around 15% from its high because of this demand we call it destruction narrative that could come into place. And what we see over here is that similar for agriculture as well. Previously was positive 10, then in Q2 they actually shared negative 6.8%. Gold was pretty lackluster, 5% in Q1. Then due to this dollar strength, they actually shared negative 6%. And worst hit was actually Bitcoin. All right, in Q2, we actually tumbled by 57%, 56%, and Ethereum tumbled by horrendously 67%. So as you all know, what happened? It all kickstarted by this over leverage behavior by market participant in this OPEC DeFi, system. Okay, and the one that is one asset class that is performing well together with the China big tech and China stocks is the US dollar. Okay, plus 6.5%, and Q1 is 0.28%. Okay, so as you all know that if you believe in trend, since we have 2 quarters of downtrend for US for equities, the trend should actually follow. It's got trend persistency. Yes and maybe no, but before we answer about this trend persistency, that means what do you mean trend persistency? Trend persistency believe that if previous performance, there is possibility that it will start to have a similar mirror image in the next future period. This is what I call trend persistency. It may or it may not happen. okay, we got to actually look at other stuff as well. So the key takeaway on share over here is that markets do not move in vertical fashion. That means it's not one straight line up and one straight line down. However, they evolve in cyclical waveform. And what's interesting in the market and what keeps me awake and keep me, we call it fascinated since when I started my career in directly involved with the financial market is this cyclical waveform that is forever changing. And more importantly, the challenge for us and for me is to understand this cyclical waveform and how to take advantage of any movement that we may see that, hey, it may start to change, revert, or continue its previous trend. All right. So now let's take a look at the bear markets of SPX, which is indirectly one of the most liquid traded market in terms of depth and in terms of the number of instruments being listed on the US stock market. Okay, so SPX 500 is, we can consider use it as a barometer for global equities. So we look at the last two bear market, right? In the dot-com bubble, and this is the great financial crisis. All right. So we start from the dot-com bubble first. For the March high, all the way down to September 2001, the market shed by 39%. So after 39%, there was actually a rebound of 24 or 25% before another leg down again to actually plunge by 34% to hit a major low of October 2002, and thereafter it kickstart another major uptrend that lasted for 5 to 6 years. All right. Then after that, if you look at the great financial crisis, the GFC, triggered by Lehman Brothers, October 2007, plunged down to March 2008. Oh, pardon me, it's a typo error here. October 2007, yeah, March 2008, yeah, March 2008, correct. So it plunged by 20%, which is the official bear market territory. Then thereafter, it has a rally of 14 or 15% before this horrendous plunge of negative 53%. So what you can see over here in the last two major bear market from the dot-com bubble and the GFC, the Lehman Brothers induced GFC, Great Financial Crisis, there is a punctured or a pause in this major bear market for a corrective rally first before another leg continue downwards. And usually the last leg that continue downwards will be the most severe or significant plunge in terms of percentage and in terms of the time taken to actually finish this plunge. This is what I call the capitulation. That means it could be triggered by something, a black swan event that is being unknown yet in the market. But however, this is what I call the major wash off to actually remove all excessive, what I call it, optimism in the market, where the market could actually found certain what I call potential valuation that is attractive to actually begin building up the base for the next major bull run. So what we could see over here is this is the start of January 2022. That means this is the all-time high of the SPX. So far, using the 17th of June 2022 close, it fall by 24%. Okay, so this leg itself, it could represent potentially the first leg that we'll start to see in the great financial crisis, in the GFC major bear market. It means from the October 2007 to low of March 2008, or the first leg of this dot-com bubble burst, March 2000 to September 2001. All right. Okay, so could this be another relief rebound from here? So to answer this question, right, we need to look at other instrument, tradable instrument, okay, not economic data, tradable instrument that are being derived from the market sentiment. Okay, as you all know that, firstly, to look at the so before we talk about, we need to understand the current fundamental situation first, before we look at what I call technical analysis. So the key thing is this recent decline from January 2002 all the way down to 17th of June 22 low. I mean 6 months, 6 months of major downtrend bear market. What is the fundamental factor that drives this bear market? That means what is the catalyst that kickstarted this bear market? As you all know for sure, hawkish Federal Reserve monetary policy. Okay, then we ask ourselves, we take a step back, what causes the Fed to be so hawkish? Inflation, agree? Inflation. So what if now inflation starts to slow down? This question, if inflation starts to slow down, this is where the Fed itself may say that, hey, perhaps what we did in the last 6 months is sufficient enough, and we may now pause our hawkish rhetoric to take a look how the market react in terms of economic data. But bear in mind, we don't trade economic data. We trade financial instruments who are always forward looking ahead of release of economic data. Okay, so this is something that we got to bear in mind of. So how do I look at whether inflation may cool off from a expectation perspective? Okay, I want to talk about expectation, not looking at inflation that's reported every month. So that one is more coincidental and lagging with your data. Okay, so one of the data that I look at will be this one called inflation expected US, derived from this 5-year break-even inflation and 10-year break-even inflation from tradable instrument, which is the TIPS. That means Treasury Inflation Protected Securities. You all can Google TIPS. What is it? So basically, it's this is a Treasury bond who give you a yield, but this yield is in line with the current inflation over here. So it's derived from there. So it's derived from the tips. From that, we are able to get what is this 5-year break-even inflation and 10-year break-even inflation. Is in a nutshell what market participant believe from their behavior, their trading behavior in these tips. That means it's a 5-year ahead future inflation and 10-year future inflation. All right. So if you look at the blue line and the orange line, both the 5 and 10-year actually form a significant peak in March and April this year. And even during the last Federal Reserve FOMC announcement, where they actually reinforced their hawkish rhetoric to say that, hey, we may now look at, previously they talked about 50 basis point hike, now they're talking about 75 basis point hike. So since then, what's interesting over here is that this forward-looking inflation expectation ever since has continued to cool down. All right, it's started to cool down. All right, so despite the Fed funds that is keep on increasing over here, but forward-looking inflation expectation has started to cool down. And interestingly, the cooling down of this forward-looking inflation expectation also came hand in hand with the pullback in oil prices that came slightly later. Inflation expectation formed a major, we call it interim peak first in March, April. However, oil price going to rally, but they start to actually pull back only slightly in June. That means we're talking about around 2.5 months later, and they shape this pullback. So for sure that we know that this one here has a forward-looking element to it in terms of inflation. Oil also is a factor to consider about inflation. Why? Because higher oil prices will solely fit into your daily necessity. So definitely, if a cool down in oil price, that means going forward, your CPI date number should actually starts to starts to actually ease off as well. All right. So what it means over here, this chart over here is that, hey, that means whatever the Fed did in the last 6 months, together with the behavior of oil prices, it starts to create an impression towards the market, and it creates this sentiment saying that, hey, the Fed has hiked aggressively and potentially it may start to slow down demand growth. A slowdown in future demand growth, there'll be less spending, less capital investment. So all this will lead to prices and goods and services to actually cool off as well. So that actually explains why this forward break-even inflation has been inching downwards since March, April 2022 interim peak. So if this inflation expectation continues to ease downwards, that means the Fed itself, that means the possibility of them pausing this current interest rate hike, the time frame for them to pause is getting nearer and nearer. All right. Now, next slide. Treasury yield. So as you all know that US Treasury yield is considered as a longer term of cost of funding. Why? Because let's say if you go to a bank to borrow funds, the bank got to price your loan, right? So how they price your loan is they got to take a risk-free rate plus your credit rating, depending how good you are, how your credit worthiness. So where do they get their risk-free rate? So the risk-free rate they will get from an instrument that is deemed as the very least likely for it to default. And globally, the global benchmark risk-free rate will come from the Treasury yield, the US Treasury yield. So that is, I mean, what's the possibility of the US government going into default? All right, I think it's quite slim right now, right? Given that the whole world still use US dollar as a major invoicing for terms and for number one for transfer of capital, transfer of capital, we call it capital instruments. That means we talk about financial markets wise, as well as international trade, which is being invoiced in US dollar. And even most of the commodities are being invoiced in US dollar. So what's interesting over here is that the reason for in this we call it inflation expectation since March to April also has an impact on this US Treasury yield. So the US Treasury yield has been in a major uptrend since March last year. All right, it's been, but however, once it hit this 3.54 resistance level, and if you look at the RSI, the 4-hour RSI, the daily RSI also hit the extreme overbought level and start to form this bearish divergence. That means start to see higher high in Treasury yield, but not higher high in the RSI. And thereafter, it started to actually trade downwards, all right, over here. And there's still some risk for it to see further downside as it hasn't hit the extreme oversold yet. So all in all, what we could see over here is that it actually translates, right, at this US Treasury yield, the 10-year Treasury is now doing a pullback or a consolidation mode below 3.54 with the potentially hitting 2.7 and 2.55. So if this scenario starts to materialize over the next 1 to 3 months, that means we talk about a lower cost of funding as well. That means what we see now is lower inflation expectation lead to a lower cost of funding. That means, i.e., the drivers that actually causes this drastic negative feedback loop in risk asset, which equity, has starts to get negated over here. All right, and those who knows technical analysis, right, this seems to be a head and shoulder, shoulder, head, left shoulder, head, right shoulder, as this high here, 3.08, that was met about 2 weeks ago, then actually is lower than this left shoulder high. All right. Yeah. So now, given that US Treasury yield, with the risk of shaping this further pullback, as you all know that bond prices and yield, they move in opposite direction. That means if yield starts to go up, bond prices should increase as well. So this is what we see over here. Since March 2020, this Treasury bond, the prices of the Treasury bond has been in a major downtrend. But what's interesting over here is that since early part of July, it actually hit a long-term support level at 108.10, which is this ascending trend line from June 2007, and it formed a bullish hammer. So potentially right now, it could be actually doing a retracement of this major 2-year or major downtrend to retrace some of the losses to shape this potential tactical rebound over here, okay, towards 12240/12510. All right, so if you look at this correlation between bond prices and equity that has taken shape in Q1 and Q2, so with the potential pullback in Treasury yield leading to this tactical rebound in this TLT, which is the ETF on this 20-year plus US Treasury bond, that means it could actually give a bit of relief for equity as well, given that both of them move hand in hand in Q1 and Q2. So if you look at the current flow, lower inflation expectation, it lower your cost of funding as expressed down by the US Treasury 10-year yield. Lower US Treasury 10-year yield increases potentially the price of bond, and given that bond and equity move hand in hand in Q1 and Q2, it could create a positive feedback loop into the global equity space. All right. Now, and also if you very quickly, if you tie in, this is the considered as the VXTLT. That means this is the volatility index, but not on the stocks, not on SPX. You know, SPX is called VIX, right? VIX, right? So this is a volatility index, tradable one on the US 20-year Treasury bond. So what it means that over here is that as long as it hit a certain peak, so this is the capitulation point, 3.32.68. That means, i.e., this last push down is considered as a capitulation. Why? Because if you look at the candle, yes, it showed a high, but it did have a weekly close above 32.68, and thereafter it just starts to shape this inch downwards from this 32.68. That means what it means that this last push down is considered as a capitulation move if you look at the VXTLT index, because that means this last push down, i.e., from here, is driven by a relatively high extreme fear in the bond volatility index, right? Which is also further supporting this potential tactical rebound, given that this last push down is considered as a capitulation move. Okay, now what's interesting over here is if you look at this, 3 months running 3-month performance as of 19th of June 2020. It's not static 3 months. That means it's not the start of the year 3 months. It's moving. It's a moving 3 months performance as the year progresses. So it's considered as a moving 3 months performance. So we could see over here, right, in the early part of this year, especially to late of June, the one that we call it the K-shaped phenomenon, the one that is outperforming is this Crane Share CSR China ETF. It's an ETF listed in the US Stock Exchange. Then you have the Hang Seng Tech Index, pardon me. And you have this iShares China Large Cap ETF as well, listed in US, FXI, the ticker code. And you have this CSI 300, then followed by Hang Seng Index. So if you look at this is the K shape, that means they are actually going upwards. But however, the other equity classes, the other we call it regional equity, the Straits Times Index, the MSCI Asia Pacific X Japan, the MSCI Japan, the SPX 500, the Nasdaq 100, as well as Europe, the MSCI Core Europe ETF IEUR has been shaping this K shape over here. That means positive performance by the China related equity, but negative performance at the bottom, which is over here. But if you look at recently over here, those that is underperforming right now is actually trying to play a catch up. Okay, notice that they are just sloping upwards, play a catch up together with this. That means the outperformance gap has started to get narrowed down. All right. So what we could see is that over here is that what's interesting over here is that this catch up in the last 2 weeks also came hand in hand with this uptick that we've seen in KWEB, as well as the CSI 300 and FXI. All right. So what's interesting over here is but Hang Seng starts to go a bit of sideways for the last 2 weeks. So what's interesting over here is that yes, at the start of at the initial start of the year, that means we're talking about somewhere around early. We're talking about from May all the way up, from early start of the year all the way up to June. There's this K-shaped performance. But however, now this K-shaped performance has starts to converge. It converge on the positive side. That means those lagging one is actually right now trying to play a catch up. The sloping upwards, they're actually turning up with the previous outperformer, which is the China big tech stock and China related equity. All right. So all in all, this chart represents, hey, not too bad. The markets right now is actually doing some signs of positive sentiment, and they are playing catch up hand in hand with those guys who are actually outperforming at the start of this year. Then now the next slide, like I share over here, is China credit impulse. So credit impulse, right, can be considered as a liquidity indicator. So basically, those want to know the formula. This is the China Bloomberg Credit Impulse Index. So this is based on data of 22nd of June. So they only release every month. So the next data for the month of for the next data will be around 2 days from now. 2 days from now, you'll see the latest data. They will really release every month, not every day. So this is based on data from May. So that means 1 month later. But what you see over here is that an uptick, a significant uptick year on year. This is a year on year percent uptick. Is still negative, but this negative number is getting smaller and smaller. A significant uptick in China Bloomberg Credit Impulse Index always will have a leading, we call it leading indication. They actually lead ahead of the up move in the stock market, which is represented by the China CSI 300. Over here, you could see it move up first before the China CSI index move up. All right, similar from here as well. Okay, before the CSI move up. So what we could see over here is that an increase, a significant uptick in credit impulse index on the average has a leading element, or is a leading indicator that could actually create a positive feedback loop into the China equity market, which is represented by the China CSI 300. So what we could see over here is that this line, you could see that this white line, where we start to see a higher low in the credit impulse index. Then from here, previously, the CSI still turns downward. But after that, when your credit impulse index start to see a series of higher high, this is where the CSI 300 in the last month or so, 1 month or so, starts to shape that tick up. All right. So what we could see over here is potentially, given that CSI right now, the credit impulse tend to lead rally in China CSI in prior observation. That means with a continuation of uptick in this credit impulse index should actually support a further potential up move in the China CSI 300. So basically, for those who know the basic formula, what this credit impulse index is, it's actually new loans divided by GDP. All right. Another one, as you all know that if the dollar strengthened too much against the offshore yen, we may start to see a currency war. So that what happened in 2016, where the yuan itself devalued against the dollar. That means the yuan weaker against the dollar. Then this lead to other Asia currency to actually wanting to have a weaker currency as well. That means we're talking about dollar Korea. So we're talking about even Singapore as well. Those guys who are actually export oriented, and even that's facing the risk of the Japanese yen as well. So what I could see over here is that at this point in time, since hitting this medium-term pivotal resistance at 6.817 and 6.8610, it started to trade sideways, and that was 13th of May 2002. And if you look at during this period of time, right, from 13th of May all the way up to the last 2 months, that means about June and July, dollar actually strengthened against other major currency. That means against the euro. Later I'll show the chart of the FX market, against sterling, against Aussie dollar, definitely against the Japanese yen. But what we could see over here is that, but the dollar didn't strengthen against the CNH over here. So this actually also gave credence why the China-related stock market actually outperformed in Q2, because the yuan weakness is being kept below 6.817, 6.8610. Oh yeah. So all in all, what we could see right now is that the RSI over here is that remains momentums. There's no clear upside momentums. RSI remains after this bearish divergence on the RSI. That means indicating to us that yes, this is the last a very significant up move, but this up move here doesn't reflect it in the momentum. Momentum starts to slow down. Then now RSI is being kept by a corresponding resistance at the 61% level. So what we could see over here is that potentially, right, if this dollar CNH will going to consolidate further. That means no clear dollar strength in CNH offshore yen. Then if a break below 6.67, it could actually shape that more significant pullback towards 6.5840. So that's actually this lack of dollar strength in Chinese yuan actually reduced the threat of this currency war, which is also pretty beneficial to global equities as well. All right. So basically, this is the Q3 2022 outlook theme. Okay, so basically easing inflation expectation, the first part I share with you all, is actually offer this potential relief rebound in equities and bonds. All right. Then a lot of people will ask right now is that, hey, will this relief rebound lead to a major bottoming formation? That means, i.e., whatever you see right now here, potentially could start to see fresh all-time high in US stocks. Well, everybody hope this is the best case scenario, right? But we got to, but unfortunately, there's not enough elements right now to say that we are actually totally out of the woods. That means from here all the way up, we'll go to fresh all-time high in the Nasdaq 100, fresh all-time high in the SPX, or even fresh all-time high in the STI if you want to. But unfortunately, there is no clear major bottoming process yet for this asset. Why? So these are the couple of slides that I share with you. What we could see over here very quickly, this line is a 10-year spread, the dark blue line, the US 10-year yield spread minus the 2-year spread, and the red line is the 30-year minus the 5-year yield spread. So what we could see over here is that both of them actually inching towards down. The 10-year minus 2-year is already in yield curve inversion mode. Very closely now is the 30-year and 5-year. So usually when this yield curve inverted, that means the 10-year year is less than the shorter, means longer term year is less than shorter term year. It usually precedes a US recession from here. So as you all know that if you look back in the past, in order for a major bottom to be formed in stock market, usually we need to see a recession first. Then I would say that a recession got to come in line first before the bottom could actually form. You see, and don't forget over here is that if at the bottom over here is this Chicago Fed National Financial Condition Index. That means it's a gauge about whether liquidity condition is actually tightening or loosening in US. So if this black line keep inching upwards, that means liquidity condition is tightening. Okay, so this liquidity condition can be anything. It will be a broad base of liquidity index, like money supply. We talk about a spread of even the 10-year and 2 years because it's part of the instrument as well. So there's a we call it a basket of factors that this or instrument that Chicago Fed actually used to actually come up with this National Financial Condition Index. So for those who are interested, can actually Google to find out more about the basket of this National Financial Condition Index. But for sure, if you look at the current push up from a low of negative 0.8 at this moment in time, it's actually tightening up at a similar pace before the 2008 Great Financial Crisis. That means what you call over here is that there's still a risk of stagflation. That means weaker growth, inflation is still there potentially, and liquidity condition continue to tighten up. All right, that means it's not loosening, it's going to tighten up. All right, so there is still a risk that we may start to see another leg of risk off going forward after the relief rebound is over. Okay, and the next one over here is this. Yeah, just now I shared with the daily chart, right, of the US Treasury yield. So if you look at the bigger picture, which is the monthly chart of the 10-year US Treasury yield, so what you could see over here is that in this bullish breakout above 2.55, all right, okay, it's actually broke out of a long-term circular downtrend channel that's more than 30 years, that's close in place since October 1987. Okay, so potentially that means, i.e., right, with this significant breakout of this major circular downtrend channel, we could still see further momentum for the further that US Treasury yield after that pullback and pause that I highlighted to you earlier at this 2.55% level maximum. So holding above 2.5%, you may see another push up thereafter towards 4% / 5.2% towards this major resistance zone over here. So if this scenario were to actually take shape, right, the tech and growth stocks, which is represented by Nasdaq, growth will be the small cap Russell equity, are likely to be the worst hit and underperform against the broad market, as shown by this ratio chart itself over here. So if you look at this ratio chart, right, the Russell 2000 has been underperforming the S&P 500, and if you plot against the Nasdaq 100 versus the S&P 500, recently it managed to actually broke below the peak that was formed in the prior to the dot-com bubble. And what you see over here is that before it break down this peak, there is a formation of this double top kind of thing. That means a divergent, bearish divergence. We start to see that the higher beta stocks, which is the tech stocks, is getting weaker or underperforming the S&P 500, which is also not a good sign for a global, we call it risk on risk off perspective. That means, i.e., if this US Treasury yield, after shipping that potential pullback that is in place, right, potentially in motion right now towards in motion, that means in play right now, towards 2.5%. Then after that, from 2.5%, it start to shape continuous this rally because of this long-term bullish breakout from this long-term descending channel, giving it we call it a greater impetus to shape further push up towards the 4% slash 5.2% level. So if that's happened, right, that could actually add another round of downside move in Nasdaq 100 and the Russell 2000. So these two are tech and growth counters. So if these two Nasdaq 100 and Russell 2000 starts to fall further, it could actually create a negative feedback loop to the entire global equity space. All right. Now, next will be, as you know, that tradable instrument, right? One instrument you look at is Dr. Copper. So Dr. Copper, right, is considered as a barometer for global economic growth. Why? Because if you look at industrial activities, they require copper, right, to actually either as a finished goods or as one of the inputs. So what's interesting over here is that since it's March or high, this is the copper futures are traded in COMEX US. So it's two decimal place. I don't use the London one. London one is the 1000, but they will shape the similar technical configuration. So it's a very long-term monthly lock chart. I put it lock so that there's more clearer price behavior. So if you look at the February 2011, previously it did a failure bullish breakout, and from the March 2022 high of 5.04, it actually shaped a negative 37% or 38% decline to the current July intra-month low. So right now it's trying to actually shape this, we call it a minor rebound at this 3.36 level. So all in all, I could see this movement over here, right? And also interestingly, the RSI start to shape this bearish divergence as well. Higher high in price, failure bullish breakout above the Feb 2011 high, bearish divergence, indicating to us that lack of upside momentum follow through, and this is a monthly RSI indicating to us that, hey, there is potentially much more downside to come before hitting the oversold level. That means we're talking about, since this is one candle equal to months, that means talking about in this coming 3 to 6 months down the road, potentially your copper futures could actually hit this key support at 2.49%. All right, so if you break below 2.49%, you will 2.49, not percent, 2.49, you could see 2.0. So this 2.0 over here is considered a neckline support level if you look at this as a double top formation potentially. All right, so all in all, right, we start to see that copper itself is actually flashing topish configuration, which is bearish instead of bullish, and this is a longer term chart. That means, i.e., telling us that, hey, economic activity is not rosy at all, as indicated by the price of Dr. Copper. So that actually supports us that the previous positive element that I shared with you at the start is more related to a corrective rebound, a relief rebound, or somebody may call it we call it a dead cat bounce, but the dead cat bounce could last for a longer duration. Instead of weeks, it could last for months over here because of some of the factors I shared with you. But thereafter, potentially, we may start to see another leg of we call it another multi-month move of a bearish down move in risk asset, which is equity. Now, with that in mind, let's quickly, or last one, okay, previously I shared with you, if you those who know sector rotation, right? So sector rotation over here is that previously one of the lagging sector, which is energy, has started to outperform since late last year, and it was the best outperformer in Q1. Then, however, in Q2, it started to decline over here. So what we could see over here is that previously the clear outperformer, which is only energy, is the 11 S&P sectors. This is the 11 sectors that consider the S&P 500. Their outperformance starts to dissipate and losing upside momentum. Based what it means that over here is that the previous lagging sector, energy, previous outperform, it start to outperform because it lags. So this is the fault that is holding the last fault seems to be the last fault that is holding the market, and right now it starts to actually outperformance starts to dissipate over here. So this also represents something that, hey, it's not going pretty much of a good sign as well, to say that this is a major bottoming process. All right. Now, with that in mind, over here is that also very quickly, right, in terms of earnings estimation, that means you plot the 12-month forward earnings per share estimate. That means compiled by Bloomberg as of 21st of June, which I took it. If you look at, yeah, even though the MSCI All Country World Index starts to come down from its all-time high since January, but however, earnings expectation, right, 12-month forward earnings expectation are still pretty rosy. That means there's a big risk that earnings expectation could actually see risk of further downside reversion. All right. So if you start to see analysts start to cut earnings growth much more, we call it much more hectically or much more pronounced in the next couple of months, or from here, we could actually create a negative sentiment feedback loop back into the market itself, which is back into the stock market. And what you could see over here is this is the SPX. So the SPX over here is that SP 500, the 12-month forward earnings per share estimate by analysts so pretty rosy. So it hasn't been revised downward significantly yet. And what's interesting over here is if you look at the previous two bear market, right, the one in dot-com bubble and the 2007-2008 great financial crisis, induced by the Lehman Brothers bankruptcy or triggered by the Lehman Brothers, is that it's only that when the stock market goes down further downward, then the analyst expectation starts to do that downward reversion. Similar for here as well. All right. So what we could see over here is that it's more like a lagging indicator. That means if this guy continue to cut down, that means if this guy continue to slope down, that means earnings start to see this downside reversion. It actually also create this feedback loop back into the market as well. But when they start to cut significantly over here, we more or less know that more or less a bottom is reaching soon for the market. All right, so they are lagging. So what it means over here is that they even haven't come down yet. There's still no clear downside reversion at this moment in time. So it's only that, I mean, the downside reversion haven't even started. So if you look at the past behavior in the past over here, in the past two market, bear market or the SPX, this earnings downside, forward earnings is still rosy, hasn't even started to cut yet over here. So it means that we have not even formed a major bottoming process yet for the SPX 500, taking into the past behavior of how they behave. So with that, right, we now have a clear picture. The theme that I want to share is number one, yes, potentially we could see a corrective relief rally for this quarter, but however, it's not the start of a major bottoming process for risk asset and equity as per se. Means after this corrective rally is over, potentially we could start to see another slide, means another bear market to even take out the lows of May and June. So now the next key thing is what is the key level to maintain this corrective rally, and how high potentially this corrective rally will go potentially. So this is where I introduced the technical chart. All right, the technical chart based on yield wave and momentum and graphical. Okay, so very quickly, right, this is what we do in Q2. So Q2 previously we're expecting the SPX to actually hit 37.20, bounce a bit before going then thereafter 32.50. All right. So what we could see from here, okay, the SPX already hit 37.20. All right, very close to it, 37.20. So right now I'm using 35.80 as this long-term pivotal support for this quarter, looking to shape this potential corrective rebound. So the corrective rebound resistant level to watch, we got the wave B, which is the retracement from the all-time high towards the current low, the current we call it a June or May low over here, 50%. And also this retracement corresponds with the 55-week moving average acting as a resistance right now. 4217/4310. All right, on the SPX 500. So very similar for this recap for Q2 or the Nasdaq 100. So the time we have a bearish view looking to hit down 10,960/750. Then further thereafter there will be a further move towards 9650, 8890. So I could see that the 1060/75 exactly been hit. So this will be the long-term pivotal support that I have for this Q3 to maintain this potential corrective rebound towards 12,960 and 13,900, which is also the 50% retracement from the all-time high towards the low that we see in May and June this year. And what's interesting over here is that the RSI has really hit the oversold level and it starts to shape this bullish divergence as well. So in terms of momentum, it's telling us that this first leg of major downtrend means close to 7 months or 6 months. We look at it 6 or 7 months from November 2020 to this low, this June low over here. Downside momentum has started to abate or start to ease off, where it could actually give further credence to this potential corrective rebound that is taking shape right now. So as long as 10,960/675 long-term pivotal support holds from here, that means no weekly close below this level. If a weekly close below level, then we will start to see another major impulsive down move sequence again to hit the next support level 9650. Then followed by 8890 level support. All right, now Dow Jones. Okay, Dow Jones previously in Q2 we expect to go down to 29,600 level, then maximum 26,000 level. All right, so what we see now is the 29,600 level almost hit. So I'll be using 29,400 as a long-term pivotal support for this quarter Q3. So also looking for that corrective rebound towards this resistance at 33,200, maximum 34,160. And also on a weekly RSI, so shape that bullish divergence at its oversold level, indicating to us that this major downtrend, downside momentum has starts to ease off. That give credentials to this ongoing corrective rebound process as long as 29,400 holds, no weekly close below 29,400 for the Dow Jones Industrial Average. So the last one for the US major indices will be the small caps Russell 2000. So this Russell 2000, right, previously we are looking at a push down to 1740/17 figure, maximum 1540 in Q2. So over here is that the 1700 figure hit over here. So now it's actually at a graphical pullback support level. So I'm using 1610 as my long-term pivotal support, looking for a potential push up towards this corrective rally towards 1950, 2100 figure level. And also the interestingly, the weekly RSI also shaped this bullish divergence in its oversold level. Right. So as long as no weekly close below 1610, potentially we could start to shape this corrective rebound in first step towards 1950. All right. Now for the Hong Kong 50 index, so Hong Kong 50 index previously we're actually looking for this kind of push up towards 23,000/380, then before coming downwards 24,700. So right now what we could see right now over here, yes, it did shape that push up and it trades sideways. So what we are expecting right now, given the positive momentum that is being seen on the weekly chart, the weekly RSI, in the major US stock indices, we could actually start to see a push up towards the top of this sideways range configuration at 23,000 level /23,725, as long as there's no weekly close below this long-term pivotal support that's set for this quarter on the Hong Kong 50 with the Hang Seng Index at 18,050. All right. Okay, now for the Japan 225. So previously for the Japan 225, right, we're actually looking for a push down to 24,180. A break below could go us lower to 21,600/20,240. Very interestingly, right, yes, it did shape that push. It did shape that push down, but it didn't break below 24,180. All right, and it just goes straight sideways thereafter. the last 3 to 4 months. Okay, so what we could see that right now is that given that it seems to me that it starts to consolidate in a potential symmetrical triangle range configuration. So I will remain neutral for this quarter between 28,750 and 24,180. That means it's more like a sideways range configuration for the Japan 225. All right, for this coming quarter range bound. Okay. Now for the German 30 index, so previously German 30 index, right, we're looking for a push down towards a downside trigger level at 12,430. We need to have a weekly close below this level to actually shape further push down, as indicated by our previous Q2 outlook towards 11,330, then 9,580. So what interesting over here is that yes, it actually shaped that push down towards 12,400. Let's go at 12,430 with a low at 12,385 last 2 weeks ago. But what interesting over here is that after this test of this downside trigger level that we highlighted in Q2, it actually formed bullish elements, which is two bullish hammer candlestick formation, and the RSI start to shape a bullish divergence at its extreme oversold level. So indicating that this 1 month plus of decline over here is kind of a bit overdone. Momentum is losing strength, and I'll be using 12,385, which is the low over here, which is close to 12,430. I just put the low 12,385 as the long-term pivotal support for this quarter, looking for a push up to retest this former swing high area over here at 14,500. So it's more like a sideways range, a push up towards the top of the range resistance again, as long as there's no weekly close below 12,385 long-term pivotal support that we set for this quarter. Okay, now this is what we see on the Straits Times Index. So the Straits Times Index in Q2 previously, we have a view that it will test drop towards 30,20, but you need to have a weekly close below 3020 to shape further downside towards the lower, towards this ascending trend line support long term that is in place since August 1998, which is the Asia financial crisis low, all right, which is at 2630. So what's interesting over here is the STI, yes, it came down and it came very close to the 3020 level, the 3020 level that we highlighted in Q2, and it's now start to shape a bit of bounce on the daily chart. So this is the monthly chart. So given the elements are kind of mixed right now, so I would rather prefer to turn neutral. Rather, that also do not forget over here is that we start to see potential corrective rebound scenario in other developed nation indexes, which is the US stock indexes that I covered earlier, together in Hong Kong and EU. So very tough for the STI to actually break below 3020, because usually we are a price taker rather than price setter. So given the positive corrective rebound scenario in this major US stock indices and other developed nation stock indices, I would prefer to turn neutral for this quarter, given also mixed elements of between 34 levels. So 3400 level, 3400 level is pretty key range top here, can't break above, and also the 3020 level, okay, as my lower boundary of this sideways range. So sideways between 3400 level and 3020 level for the STI. All right, now next one will be the FX. Okay, so if you look at the FX space, so this is a 2000 year-to-date FX performance. So this FX performance over here based on 19th of July, so we could see is that this is using dollar as a base currency. That means $1 equals to how many yen? $1 equals to how many sterling? $1 USD equals how many euro? So what we could see over here is that the outlayer right here is the dollar Japanese yen. That means the dollar has been strengthening progressively against the Japanese yen. Year to date is up 19.7%. All of them are positive as well, right? But what's actually underperforming is the CNH, the Swiss franc, the Aussie dollar, the Sing dollar, and the Canada dollar. So what I could see over here is that the last couple of days we start to see a bit of dollar strength pullback as well in other pairs over here. If you could start to see this point in time. So all in all, right, what we could see is that hey, dollar strength is actually now starts to give a bit of give back or retracement, with the exception of against the Japanese yen, which makes sense. Why? Because the BOJ, the Central Bank of Japan, doesn't give a clear indication that it will start to normalize interest rate. That means they still want to keep ultra low interest rate in Japan together with the yield curve control program. That means still continue to do that, whatever monetary experiment in terms of QE, but the rest of the world, especially the one that is still lagging, even the Euro ECB, in the last couple of days has started to indicate to kickstart their normalization cycle to kickstart interest rate hike tomorrow. And even there's actually a possibility of hiking 50 basis point tomorrow against the general consensus of 25 basis point. All right. So for those, yeah, somebody give me a Q&A. I'll answer that Q&A later. So allow me to continue my presentation first. Thank you. So what we could see over here now is this is the monthly dollar index. So this was our recap of what we expect in Q2. So we expect in Q2, yes, there's a bullish breakout in 103.65. It will hit this level, potentially go up further to 109.30 slash 112.30. Okay, which corresponds to the upper boundary of this ascending channel and this congestion zone over here. And also there's some FIBO retracement, which is the 76.4% FIBO retracement from the previous major downtrend from July 2001 to March 2008. That's the 76.4% retracement, and the fifth wave target is here as well. All right, so what we could see over here, the time we tightened the pivotal support to 93.20. So last few days, it actually managed to hit this level, 109.30, right at 109.30. So this consists the fifth wave target in terms of Elliott wave, wave 1, wave 2, wave 3, wave 4, wave 5. And also this Elliott wave target corresponds to a FIBO retracement and expansion level, which is 109.30 slash 112.30, corresponding with the RSI coming very close to the extreme overbought level. And bear in mind that if you look at this steep up move from Jan 2021 all the way up to July 2022, close about 2 years plus, 1.5 years. This similar steep up move is very similar to this steep up move that happened inside this cycle, this broad-based 5-wave major up move cycle. So after this steep up move in January 2017, it started to trade more like sideways. We start to consolidate to form a low in February 2018. So all in all, what I could see over here is that technically right now, dollar is actually ripe for this potential 1 to 3 months of retracement, dollar strength retracement. And don't forget, dollar index itself, right? The major with the heavy, these are the three biggest weightage inside. Euro dollar, then after that Euro followed by Japanese yen and sterling. Then Euro is the most significant with close to I think 55% weightage, more than half is weighted inside the dollar index. All right. So the previous, if you look at the previous move, this previous last couple of weeks of down move actually triggered by the Euro dollar rebound. Okay, after hitting slightly below parity. All right. So given that also the last couple of months, one month ago, you look at the futures positioning size, futures positioning in long US dollar index has been also on the extreme end over here. So given that overcrowded net long position US dollar index, so any little move of retracement, it could actually kickstart of stop loss being triggered, and this which will lead to what I call potentially unwinding that could lead to also what I call an erupt, what I call that we call it a behavior in market participant that could actually snowball to this dollar strength retracement. So I'm watching 103.20, a weekly close below 103.20, potentially could take us down towards 99.25, maximum 94.50 on the dollar index. All right. So with that in mind, if you look at the chart of the major currency right now, okay, this is euro dollar. So before you know, sterling dollar, pardon me. Previously, we're looking for a push down towards 114.10. So what we see right now is coming very close to 114.10. So far, intra-month low, July is at 117.60. What's interesting over here is that at 1960 level, that means this level here, it hit close to 1916 level, 1.1916 level. There's this bullish divergence exactly formed at the weekly RSI at the support level that we predefined earlier. So momentum is losing strength right now, means downside momentum is losing strength. So this actually gives prudence to actually shape this corrective rebound. Similar price action what we see earlier on the stock market, on the stock indices. All right. So potential corrective rebound resistance level to watch 1.2730 as long as there's no weekly close below 1.1410 on the sterling dollar. All right. If this level starts to break down, weekly breakdown, so this is the all-time low in February and March 1985 based on my chart, 30 over years. So there's the all-time low at 1.0670, 1.0520 on the sterling dollar. All right. Now, on the euro dollar, so euro dollar previously we are looking for a push down towards 98.40, then followed by 95.90. Right. So what we could see on the euro dollar over here, it almost hit 98.40, printed a low last week at 99.50 before shipping this ongoing bounce. And interestingly, upon that, the weekly RSI started to shape that bullish divergence. That bullish divergence on the weekly RSI indicated to us that this broad-based downtrend, this major downtrend since the high of January 2021 to the low of July 2021, close to about 1.5 years, 2 years, pardon me, 2 years, close to 2 years, 2.5 years, is now losing strength as well in terms of momentum. So this give reinforce this potential corrective rebound as long as there's no weekly close below 98.40 to shape at least a push up towards 1.0870, which is the pullback resistance of this dotted gray line here that was actually taken out on the downside recently. Now turns the pullback resistance. Okay, Aussie dollar. So Aussie dollar previously we are looking for a push down towards 64.60, then 60.10 itself. So right now this was Aussie dollar, right? It actually didn't hit 60, came close to 64.60. Okay, quite close to it. Low of 66, low of 66.81 so far, and also the RSI start to shape this ascending trend line support as well. So we are using 64.60 as my long-term pivotal support, looking for this corrective push-up, rebound towards 67, 72.80, followed by 76 figure level, which is the upper boundary of this ascending, former ascending channel support turns into a pullback resistance, which is all confluence with this long-term circular descending resistance in place since July 2011 high on the Aussie dollar. So as long as there's no weekly close below 64.60 long-term pivotal support, potentially we could shape this corrective rebound on the Aussie dollar. All right. Now, next will be the Japanese yen. So Japanese previously we were looking for a pullback, then thereafter a push up towards 47.70. Okay, 147.70. Okay, so what we could see now, this is the Q2 outlook. So in Q3, right, so far there is no significant pullback. It's just, oops, it just shaped one steep rally up and broke above 35 figure level. Now en route towards 147.70. Oops, yeah, from here. So what we could see over here is there's no clear signs of exhaustion. So potentially, right, we could start to see a minor, still I will maintain that bullish bias, but with a tightened key, we call it a short long-term pivotal support at 125.70, which is the former swing high area of June 2015, and also very close to the 20-week moving average. Looking for a pullback at towards 131.25 before shipping this further melt up towards 147.70. So this is the exceptional outlier where potentially, yeah, maybe in a couple of weeks' time, you will shape this minor pullback, but thereafter, potentially, we could see a continuation of dollar strength in this against the yuan, supported by this still ultra dovish policy by BOJ. Okay, dollar cap. So dollar cap previously, we are looking for sideways move between 130.20 and 1.2060. So yes, it indeed moved sideways. But what's interesting over here is that last week, it actually did a test above 130.20. But however, what happened is I want to zoom into this area here. It actually shaped that bearish reversal candlestick formation. Here's up, no clear weekly close above 30.20, and right now it's actually shaping that we call it the evening star kind of formation, evening star, weekly evening star formation. So what we could see right now is a bearish reaction right below 130.20. So indeed 130.20 is a key resistance level, key range resistance level. So now potentially, right, we could actually see a dip down towards 1.2590. Why is it important? Because this is a ascending trend line support that I draw, and together confluence with this swing low area, which is at 1.2590. So if we have a weekly close below 125.90, potentially, right, we will see it dropping further towards the major range support at 1.2060 level. We saw this neckline support of this impending bearish top that is still forming since Jan 2016 high. All right. So yeah, so looking for a kind of a range play, but towards the bottom of the range of this dollar cat, means also dollar weakness. Now, commodities. All right. Last commodities will be previously crude oil futures, right? In Q2, we are just expecting a push up to test its all-time area at 138/140, but it didn't actually materialize, and instead it's just traded sideways in Q2. And what interesting over here is that there is some bearish price action on the WTI crude oil futures, right below this 130.50 key long-term pivotal support level. So what we could see is that also the RSI, the monthly RSI, starts to shape this exit from its overbought level. Okay, hitting over exit. So potentially, what it could actually shape a push down towards if a break below. Okay, previously it tested 93.50. So if we start to see a break below 93.50, we could see a push down toward 83.60. Perhaps maximum 75.70, which is pretty key level right here, right now. Right here, the former swing high area. Okay, now stands to pullback support. Then thereafter, from here, it may start to push up again. So it's more like a push down within a sideways range configuration for WTI crude oil futures. Then for gold, yeah, gold. Previously, we are looking for impulsive up move, holding above 1670/40 long-term pivotal support. But unfortunately, instead of hitting up, it actually went down. It broke 1850, went down to break below 1750 as well. That means trader close about 1707, but it actually held above the long-term pivotal support. And what is it doing right now? It's actually trying to actually shape a bounce close to this long-term pivotal support, and also this ascending trend line that is in place in August 2018 low. But what we could see right now is that the RSI, the weekly RSI, also attempting to actually bounce off from a support level as well, which is at the 33%, which is close to the oversold region. So all in all, right, this could actually start to see the sideways movement. It's a sideways range movement. So now we actually sideways range movement since August 2020. That means it's close to more than 2 years plus of sideways range. So potentially we could see towards a bounce off to the top of the range again. So for this quarter, we're also aggressive to play up the top of the range, perhaps play up towards this key intermediate congestion zone over here. Previously was supported and taken down at 1780/1870 in the first step. So and also bear in mind that over here, we also start to see a weaker US dollar potentially in all the major currency pair except for the Japanese yen. So as you all know, that dollar tends to move opposite against gold. So with a potential pullback in dollar strength, in substantial dollar strength that was seen substantially in the last 1 to 2 months, it could actually offer a bit of relief, rally or relief rebound towards the upper boundary of the range configuration in gold, since right now it hit at the range support level as key range support level at 1670/40. All right. Now cryptocurrency. So for cryptocurrency, right, if you look at it over here, is crypto previously returned neutral, so we do not have any clear sign to say it was go fresh all-time high above the November high at 64,900 for Bitcoin. So what happened over here is that due to that D5 blown up, it actually broke below 13,100 and floated down very close to this level over here. So let's show you this chart. So it floated down to the range over here. So what you can see over here is that this level actually confluence with this long-term ascending channel from August 2015 and also from a former December 17 swing high area. So what you could see right now is that the RSI also hit the most extreme oversold level 3 or 4 weeks ago at 2609, and last week it started to actually exit from this extreme oversold level. So indicating to us that there's some signs of momentum coming back into Bitcoin. So all in all, I'll be using 19,100/16,100 to play that potential rebound, at least a snapback rally in first step towards 13,100/34,800 level. So which is also this pullback line. So formerly 31,100 was that range support. So now turns into a pullback resistance. Unless it could clear above 34,800, then we could start to see, hey, this could be the birth of another brand new major bullish trend for Bitcoin. So until that level is being taken up, which is 34,800. So similar for the Ethereum as well. We were neutral last quarter, Q2. No conviction for it to shape a all-time high, 4370, 1930. So it actually broke below 1930 and floated down very close to this region here, which is close to the 700 level. All right, so a plunge of 81% from its current all-time high in November 21. So what you could see right now over here is started to shape a bounce, and this bounce actually took shape right at this lower boundary, very close to the lower boundary of this major ascending channel support since the low of December 2016, and also correspond to this swing high area as well, which is now 17,094. So as long as 794, pardon me, 794 long-term pivotal support holds for Ethereum, ETH/USD, potentially we could start to see a rebound back towards 1930/2540 for the snapback rally. So this is that former range support now turns into a pullback resistance. So unless 2540 breaks, that means a clear weekly close above it, then we could start to say that Ethereum also starts to shape this long-term kickstart this major impulsive bullish trend. So until now, it's still more like a snapback rally. Yeah. So don't forget over here, why is still a snapback rally? If you use the price behavior of Bitcoin and global equity, especially Nasdaq 100, they actually move hand in hand in the last 3 to 6 months or so. So if the Nasdaq 100 starts to shape another bearish move after the corrective rally end, it could actually impact Ethereum and Bitcoin as well. So the best case scenario for Ethereum and Bitcoin is that it didn't break above those resistance level. That means 2540, it didn't break above. And best case scenario is for them to trade sideways. Okay, holding about 794, and for Bitcoin is to 34,800, but the key support, that means sideways between 34,800 and holding above the key pivotal support of 16,100. So that's the best case scenario for cryptocurrency if we start to see another major downtrend on the Nasdaq 100, i.e. global equities. All right, so right now, right, I've come towards the end of the presentation. So I take you through from the Q3 theme, which is lower inflationary expectation lead to a potential relief rally. So why relief rally in risk asset, equity and bonds? I'll try to explain as well. Then thereafter, I take you through the broad-based asset classes. What are the key levels to watch to maintain this view? So now we actually open up the scope for Q&A. So I'll be answering your Q&A right now because now we have exactly 10 minutes. You're just 10 minutes to answer your Q&A. So please feel free to give me a shout out right now. Okay, so before we go into Q&A, right, before you guys type the question, I'd like to share with you all one thing. Okay, so for those, right, you can see my screen, right? So this is my social media account. I tweet every day, except for weekends, because weekends market not really open. Sometimes I do tweet on weekend. Why? Because crypto market is open if there's interesting move on the crypto market. So this is my Twitter handle. So it's free. You can just open a Twitter account. Once you open a Twitter account, find me at Kelvin SC Wong, click on follow, and there's a notification button over here. You click on notify. So once you notify, you on your notification button, whatever tweet that I tweet, you will receive it in real time as well on your Twitter feed. So what I do every day in the morning is I will come up with a daily commentary, but my daily commentary will post it in my Twitter. So I'll share with you all what are the key events that happen and how does it impact the market. All right. And even today's recording will also be posted in my Twitter feed as well. Okay, so do give me a follow on my Twitter feed to get updates, or I would say that fast updates on the global markets. All right. So okay, now let's start with the Q&A. Okay. First question. Okay, let me open up the Q&A. Oops. Give me a minute. Okay, so the first question, do you foresee that US midterm election could have an impact on the stock market? The Fed may do something to support the election. Well, this is a very, very interesting question. It's pretty tough. So do not forget, Fed itself is a central bank that has credibility. That means what they say, they must fulfill their promise. This is what a credible central bank would do. So at the moment in time, what they are looking at, Powell and his officials, the primary objective now is to tame inflation. That's their primary objective rather than growth. All right. So at the point in time, because if somewhere around we're talking about, and don't forget they have a goal, the inflation, the rate stated very explicitly is to reduce if the current elevated inflation to 2%. That's their goal. So right now we're talking about CPI is how much percent? 9%. PCE, another inflation indicator, is about what, 7 or 8%. So it's still very high. So let's say if inflation still doesn't go down to 2%, which is very unlikely by midterm election, the Fed will still be in an interest rate hiking mode. The only thing over here is that they may not hike too aggressively if inflation starts to tone down by then. That's the only positive thing. But however, the interest rate hike cycle will still be there. All right. So the only thing that we can ask ourselves is when the Fed will stop hiking. Is at the moment that inflation starts to go down to 2%, and it starts to give a bit of guidance saying that hey, we have done enough in terms of interest rate hiking, and we may now start to pause and see how our interest rate hikes as well as monetary policy tightening impact the real economy, which is inflation, and then after growth. And do not forget over here is that if okay, usually jobs numbers are tend to be lagging. So if jobs numbers still continue to be robust by the time robust as in still stabilized during midterm election, October, November, the Fed can't actually reduce or stop that interest rate hike cycle. All right. So that's my best answer I could share with you all right now, because the Fed itself, they need to have credit, because if they start to sway with the politician by suddenly they say that hey, let's put a stop to inflation, let's put a stop to interest rate hike cycle, despite inflation is still high. So I mean, at the end of the day, nobody's the Fed credibility will start to lose significantly if that's happened. All right. So I hope I could answer that question. Okay, the next question is crypto now a key asset in fund manager portfolio? Well, this one unfortunately I can't I can't answer that question with 100% certainty because I do not have any because not say I do not have any. I do not have sufficient data right now to actually say that it forms a significant portfolio, fund manager portfolio. But for sure, in the last couple of months, starting of this year, before that D5 blown up, lots of fund manager from the buy side, people had started to inquire about crypto assets, NFT, especially in the AI space. So that's all I could know. All right. So what's your opinion regarding agriculture, commodity, especially food? Okay, what I see right now is that given that this inflationary expectation it starts to ease off as more in time, and also we will start to see a kind of a big sideway this coming quarter for agriculture as well, similar with the WTI crude. But I do believe that technically, from the technical chart, the long-term circular uptrend is still intact. Technically, yeah, from the chart, potentially, yeah. What do you think is the best strategy in a bearish environment? Okay, so best strategy in a bearish environment. Okay, so okay, at this point in time, okay, previously the best strategy in a bearish environment is bonds, all right, in the bonds, right? So 60-40 portfolio. Okay, but unfortunately, this 60-40 portfolio doesn't work right now. Okay, it doesn't work right now. And if the next leg of bearish move starts in global equities, potentially there's a high odds that bonds market will start to shape another slide again, potentially. Yeah. Okay, so now the only way to hedge this bearish move in both bond and equity right now is either you got to hot cash in cash, all right, and or potentially will be dollar, US dollar. I mean, bullish dollar. I mean, after this retracement has taken shape on the dollar index. Or alternatively, if you believe, if you have time to actually look at the markets, that means directly you can potentially take a bearish position on risk assets. That could be a strategy as well, provided you have time to monitor the market. Another way to look at it, things over here is that how about gold itself? So the funny thing about gold over here is it's been pretty much subdued at this point in time. So the thing about gold over here is they're stuck. Why? Because number one, in the current risk of environment that was we seen in late last year until Q2 has been also been driven by dollar strength itself. Okay, so with this dollar strength that is still pretty much pronounced, that could actually cap gold. I mean, after this quarter, you see. So we've got to see how does dollar move after Q3, because we now know that Q3 now dollar may do a pullback. So I need to see the shape of the pullback. Can this shape of a pullback extend into Q4? If that could be the case, potentially gold could be a strategy to hedge in this bearish market for risk asset, because dollar strength start to get pretty much subdued. All right, why? Because of this potential reverse currency war thing. That means, i.e., other central bankers right now is in order to prevent imported inflation into filtering down into their local economy or country, they will use a stronger dollar, stronger domestic dollar against the USD. That means they will play a catch up in terms of monetary policy, and they will start to hike as aggressive as the Fed. So that could actually prevent dollar strength from coming back in Q4. But let's see how the pullback moves in Q3 first before I can actually give a prudent forecast in Q4 on the dollar strength thing. All right, why is gold not moving up although we have a high inflation? Oh, so I think that I really explained earlier is actually due to this pronounced dollar strength that was seen in Q1 and Q2. So gold tend to move inversely with US dollar. Okay, I hope that could actually answer your question. All right, so any more questions? We have some more. Yeah, just now it's 8:30, so I could actually answer 1 or 2 more questions before we have a good evening break. Yeah. Anyone has any questions? Feel free to ask. We have 1 or 2 more questions to go. Right now, just now it's 8:30. Yeah. Okay. Do you foresee that China internet clampdown is coming to an end? All right. Okay. Based on what we look at the current situation right now, okay, for sure, we know that China is now facing a internal slowdown in the economy. All right, for sure, definitely for sure. Why? Because you have a very stringent COVID-19 policy lockdown, and we have this liquidity crunch in the China market because of the clampdown in over leveraging practices in the property developer. And right now you start to see this filtering down to home mortgage revolution or something like that. I can't use a revolution. It's yeah, protest. Okay, protest where homeowners refusing to pay mortgages because of unfinished projects that cannot be developed by liquidity crunch or type cash strapped property developer. So for sure, we know that economic activities in China start to slow down drastically. So in order to reverse this slowdown, the Chinese regulators got to loosen this tight latch on the business models of China big tech. So I do see that at least throughout this year, there will be this clampdown is getting looser and looser, but not a totally laissez-faire movement back in we're talking about back in 2018, 2019 style of scenario. It's, I would say, a moderate clampdown, but not a total release of the ledge, because I do believe that right now China and US, they are still in a cold tech war. So the Chinese authority will actually need to have their localized China big tech company to play a part in this cold war scenario, unfortunately. So, but given the loosening of this clampdown, not 100%, at least a loosening of the ledge, a tight leash in how China big tech does their business, it could actually add a bit of relief rally to China big tech stock from here, at least in Q3. All right. Okay, so one more question. Do you foresee Hang Seng to bounce higher of next 2 weeks? Okay, Hang Seng, okay, so Hang Seng, right, for the next 2 weeks, right? So, okay, those, okay, just now I share what is I forecast the 3 quarter, 1 to 3 months potential, right? So for those, right, who wants to actually uh look at a shorter term time frame, every Monday I will come out a global market weekly technical outlook. Hang Seng is one of them. So that is a 1 to 3 weeks kind of directional bias. So I will post in my Twitter also Monday before usually about 11 a.m. to 12 a.m. You out there. So let me very quickly, right? I open my online, the online, the CMC next gen platform. Okay, because it's all in the chart there, the shorter time frame. Okay, those who join late, okay, those who join late, don't worry, this will be recorded, but I will post in my Twitter feed. So just follow my Twitter feed, and you're able to get the recording as well tomorrow by tomorrow afternoon. Yeah. Okay. So for those who ask this Hang Seng Index, the Hong Kong 50. Okay. So over here. Okay. So this will be the Hong Kong 50. So this was the weekly one that I presented earlier, 23,000, 23,725. So for this week over here is we need to have a breakout of 21,300 as long as 20,000 key minimum pivotal support holds, then we could see at least a push up to test this April 2022 and 28 June 2022 range top of 22,640. Okay, so that's my expectation within a 1 to 3 weeks time frame for the Hong Kong 50 index. All right. So last one, US 30 index for the next 6 months. So US 30 next 6 months, similarly, I expect a corrective bounce as well, corrective rebound, similar with the SPX and the Nasdaq 100. Okay, US 30. Oops, sorry, where is the US 30? Okay, US 30. So as long as 29,400 holds, no weekly close below this level, in the first step, it could actually potentially 33,200, maximum 34,160. So that is not 6 months, 3 months, this quarter. Okay, after this quarter, I got to see how this movement move. Why? Because like I shared earlier, this is only a corrective rebound. It's not a major bottoming process. That means there's a risk that the low that was seen in June, which is 29,649, could be taken out on the downside in Q4. All right, potentially. We got to see how this rebound actually evolve in Q3, which is crucial. But right now, like I shared earlier on in my slides, there is no clear major bottoming process yet to actually kickstart a major uptrend for risk asset, which is global equities. That means, i.e., for Dow Jones to hit all-time high, the odds are slim at this moment in time. All right. Okay, good. So I hope that I answered all of your questions. I hope that you find this webinar insightful, meaningful, and definitely it's for educational purpose. Okay, over here, hope that I could share as much as possible. Just bear in mind those key levels to watch. And yep, that's about it. So as usual, thank you, ladies and gentlemen, for spending your evening time with me, which I know is precious, and also giving me the opportunity to share with you. I really appreciate that. So have a great evening ahead. Do stay safe. Take care, and I see you again in my next webinar. Good night.